welcome everyone in the webcast Zoom audience. I'm Terry Maggedy, the chair of the Elder Law Committee of the Trust and Estates section. And the first thing I do, of course, is to thank the people that really make this happen for us, and that's our sponsors. And our first two sponsors will be introducing themselves. First, I'll turn the program over to Brian Joy from the Sanborn team. Brian?
Thank you, Terry. Good afternoon, everyone. As these crazy times continue, we wanted to share with you that we know how to deal with crazy situations. We recently listed a property in Baldwin Park that has an occupant, not a tenant, that is not paying rent or even allowing us into the property. We haven't even spoken to the occupant. We were able to secure a non-contingent all-cash offer at our listing price, and the property is due to close this week, so far without a hitch. The results we get when we disclose everything up front are amazing. Please consider us when selling a property with problem tenants. Thank you, everybody. Enjoy the meeting.
And now for Orit Gadish, our other sponsor.
Thank you, Terry. Hi, everyone. I'm Orit Gadish, broker and owner of Geffen Real Estate, a dynamic brokerage specializing in serving the trust and estate community. I'm also an author for the CEB, Continuing Education of the Bar, and I just wrote an article for the August edition of Estate Planning Reporter, providing a visual perspective on handling the probate of real estate assets. I recently launched my book titled The Practitioner's Handbook for Probate Real Estate. For those of you who have not read it, please take a minute to check it out. It's available on Amazon, and the link is in the chat box. Take a few minutes to read the reviews, and if you're interested in reading it and providing a review, please text me and I'll have a complimentary copy shipped to you. And if we haven't connected yet, or you need help with an upcoming real estate sale, please feel free to reach out to me and we can schedule a Zoom call to get to know each other. Enjoy your program, and back to you, Terry.
Thanks, Orit. And now our next sponsors are going to be shown on the screen, and I'll mention each one as we see them. First, thank you to Glen Oaks Escrow, Marcine Klein. They're an escrow company who works in all the areas we do, probate, conservatorships, sales related to older people. I've used them myself for a very complicated transaction, and they did a great job. So thank you, Glen Oaks Escrow. Next, California Title Company, a title company that also focuses on our areas of probate, trust, conservatorships. Thank you, California Title Company, for being our sponsor. And our final sponsor, last but not least, Manufacturers Bank, also a bank, just as the same with other providers I just mentioned. They focus on areas, conservatorships, fiduciary work, probates, all the type of banking work that we use in our elder law and probate business. So thank you, Manufacturers Bank. And next, I want to mention our program that's coming up October 7th. We'll have some people, Steve Barlam and some others from Jewish Family Services speak. Steve's spoken before to our group when he's been in this business of a geriatric professional advisor for many years, for eons, and he's spoken before. He's going to speak now with some others from Jewish Family Services to talk about all the different things that their agency does and some new areas in the field of elder care. Great speaker. It'll be a great program per usual, and that's October 7th. And now I'd like to introduce our speaker today, Joanne Crowley, great financial planner, very experienced. But what particularly pertinent for all of us is that she really knows Social Security. And I can speak from experience, being in this field for a long time. You don't run across people who are in the financial advising area, that space, who also know Social Security. It's very hard to find a speaker who has that kind of expertise. So I feel fortunate that Joanne is here to share with us her expertise in this area. And I'll turn it over to her now for the next about 55 minutes. Joanne, take it away.
Great. Thank you, Terry. That's a wonderful introduction. Good afternoon, everyone. It's great to be here. Yes, Social Security is, there's a lot to know about Social Security. I don't even consider myself an expert. I'm always learning, as we all do in our respective areas. So since we're all trusted advisors, it's important for us to be aware that certain individuals and families could be missing opportunities to apply for Social Security benefits or understand how to maximize their benefits. As we'll see, it could add up to thousands of dollars or hundreds of thousands of dollars over their lifetime. A lot of people dismiss Social Security. They think it's not going to add up to much, but it actually does when you start to look at it over your lifetime. I earned my retirement planning specialist designation after completing some coursework at Wharton about 7 years ago. And that's when I decided to dedicate my practice entirely to retirement planning. So those are people that are right on the cusp of retirement or recently retired in what we call the decumulation phase, not the accumulation phase. It's my belief that Social Security is the foundation of retirement plans for most individuals, since pensions are becoming a thing of the past. So, right, this is a pension. It's something that's going to pay out every month and has a cost of living increase for the rest of your life. And it's important to know the rules. I heard that the Social Security manual has over 33,000 pages to it. So it does get quite complex. There's a 2-page Social Security quick reference guide. I believe that was sent out with the materials in advance. And that's a 2-pager that contains an abbreviated version of the material that's in my presentation. So it could be a good thing to keep handy. So let's get started. Retirement planning years ago was pretty easy. When you turned 65, you went down to Social Security, collected your benefits, signed up for Medicare, got your pension from your employer, and that was it. So you just kind of set it and forget it. Nowadays, there's so many different types of accounts, 401ks, 403bs, you have traditional IRAs, Roth IRAs, HSA, brokerage accounts. The list goes on and on. So it's important to know which assets to tap and what order for tax efficiency and, with the goal of having your portfolio last longer. It's no longer, unfortunately, a set and forget it. It's almost something you need to review every year. And if you think about with all the changes that have occurred in the last couple of years, the Secure Act, the CARES Act, Biden's tax changes, which I guess we really haven't seen yet, it's fluid and you may need to make adjustments. So I'll be talking about 6 basic rules, but first I thought I would go into a little bit of history. Social Security started in 1935, that was 86 years ago. And originally it was benefits just for the worker. There have been amendments that have been added over the years. For example, 1939, they added spousal benefits. 1983, they taxed Social Security. Before that, it was not taxed. They added cost of living increases and many others. In case you're ever on Jeopardy, here's a trivia question for you. You'll know the answer to. Who was the first Social Security recipient? Ida Mae Fuller. She was a legal secretary. And in 1940, her first check was $22.54. She lived to 100, collected $22,889.92, and she put in a total of $24.75. So that was a pretty good ROI on her investment. So remember Ida Mae Fuller. So going on to the first rule. So monthly benefits rise with your claiming age. So how will this affect your plan? So basically, the longer you wait to file, the higher your benefit will be. And keep in mind, every situation is unique. But first, before we talk about specifics, I need to cover a couple of key terms. So PIA is one of those key terms. It stands for primary insurance amount. And this is your base monthly benefit. They first calculate it when you're 62 because you can actually start collecting your benefits as early as 62. They take your highest 35 years of earnings and they index it. And that's the amount you would get if you applied for your benefits at your full retirement age, which we'll talk about next. In case you're wondering, I do get this question a lot. What is the most that somebody could get from Social Security? So if they had put in the max every year, so 35 years, the highest earnings, they would be getting, for those turning 62 this year, they'd be getting $32.62 a month. So I mentioned full retirement age, FRA, and they used to be 65. but they increased twice the full retirement age. So if your year of birth was between 1943 and 54, your full retirement age is 66. And then they have these step-up years, starting with 1955 and adding 2 months to it. So these are the full retirement age for those born in these years. And then for everybody in 1960 or later, it's 67 is their full retirement age. They have not changed that in a while. And given the fact that longevity has been increasing, it's something they've talked about in the many things they've talked about, but they've not really done anything. So full retirement age is the age at which you may apply for full unreduced Social Security benefits. If you claim before that age, you'll get a lower monthly benefit, but there is an actuarial reduction. So technically, even if you claim earlier.
The Los Angeles Superior Court Service Desk. We are experiencing.
Okay, thank you. Actuarially, it should be about the same if you claim early. If you claim after your full retirement age, you get a higher benefit. It's called delayed retirement credits. Let's look at some examples. Now there's 2 columns depending on what your full retirement age. We'll just go through the middle column here. So assuming your full retirement age is 66, if you apply at 62, you would be getting 75% of your full benefit, which increases until 66 where you would get 100. And the right-hand column is the number if you were full retirement age is 67. However, if you wait past your full retirement age, you'll get 8% each year, and it's not really each year. So even if you waited a few months past your full retirement age, you would still get the 8% prorated. So again, looking at the middle column, if your full retirement age is 66, you would get obviously the 100% at 66, and then it'll go up 8% every year until you hit the maximum at 70. So that person would get 132% of their benefit of full retirement age. So we talked about cost of living adjustments. So they are adjusted every year for inflation. Last year, just to give you a point of reference, was 1.6%. The year before that was 2.8%. But lest you think that they've never been anything higher than that, 1980, if you remember the early 80s, it was 14.3%. And I just read recently, they haven't come out officially with it yet, but they're projecting this year or starting next year would be a little over 6%. So we'll have to wait a few more weeks to see what it actually is. So Social Security's projected cost of living over 75 years, if you want to use an average, about 2.4%. So cost of living increases combined with delayed credits really make delaying your claim a better deal. So what are the key points to remember? If you apply early, your benefits start lower and it stays lower for your life. The cost of living increases magnify the impact of whether you started your claim early or you delayed. The longer you live, the more beneficial it is to delay your benefits. Now, keep in mind that your decision could impact your survivor benefits as well. So it's important. It's pretty simple when I meet with individuals. If they can, wait till 70. That maxes out their benefits. However, for couples, you need to keep in mind the surviving spouse, who earned more money, who's older, who might pass first, and what would that do to the surviving spouse. So that's important to keep in mind. And of course, you need to take into consideration your health status, your life expectancy and income needs, and your overall retirement plans. Some people just can't wait till 70, and that's understandable. So all of those factors go into it. You can, if you don't have the software to do that, you can go onto the Social Security website, and they have some calculators. Well, number one, you should log in at least annually to look at your statement. So they used to mail them to everybody every year. Then in 2010, they stopped mailing them to everyone to save money. And then they were just mailing them to certain people. Those are getting closer to retirement. But what they're encouraging everybody to do now is to sign up online. So SSA.gov, SSA, Social Security Administration.gov, and you establish an account there. And once you do that, be aware you won't get the paper statements in the mail anymore. That's kind of their goal, but it gives you 24/7 access to your information. And again, Why am I encouraging you to do that? I had a mistake on mine many years ago. One of my clients had a mistake on hers, meaning somewhere along the way it didn't get reported, or they didn't record correctly the earnings for that year. So I had a 0 for 1 year. So it's really important, because if that ends up being one of your higher 35 years that basing your benefits on, you want to get that corrected, which you would need to do. You would have to send in some documentation and they'll correct that. So important to check your statement, establish an online account. They have calculators, so you can do some work on there to kind of predict what you would get. Basic rule number 2, now your spouse might be able to claim benefits based on your earnings record. So is it smart to do this, and how is it done? So remember, I said in 1939, the amendment allowed for spousal benefits. Women, for the most part, didn't work outside the home, and only the worker was entitled to getting benefits. So they added the spousal benefit. And the rules for that are as follows. The spousal benefit is equal to 50% of the worker's PIA if the spouse applies at the spouse's full retirement age. You have to keep in mind, they just don't get 50% whenever they apply. They have to wait till their full retirement age to get the 50%. The primary worker must have filed for his or her benefits. The spouse has to be at least 62. Now, the spouse gets reduced benefits at 62, or again, gets the full 50% if he or she waits till full retirement age. Keep in mind, there are no delayed credits on spousal benefits, so it doesn't make sense for a spouse to wait past full retirement age to collect spousal benefits. And for the most part, you can only receive a spousal benefit if it's greater than the benefit, basically your own benefit. So some of you may recall years ago, there was this file and suspend strategy that was pretty popular. So they passed an amendment and changed that, so you can't file and suspend, but there is still something that's grandfathered, and we'll circle back to that in a minute. So how would the calculation of spousal benefits work? So again, spousal benefit is 50% of the primary worker's PIA if they started at a full retirement age. So Jack's PIA is $2,000, Jill's is $800. If Jill applies at her full retirement age, her benefit will be $1,000, which is 50% of Jack's. Now, what if Jill's benefit is higher than that? So the spouse will be paid their own benefit and may not receive a spousal benefit. So similar example, but Jill's PIA is now changed. So Jack's $2,000, Jill's PIA is $1,500. Now, because Jill's PIA exceeds 50% of Jack's, if she went in to claim, they would make her take her benefit, not the spousal benefit. Again, there is an exception. Here's the exception, and I still run across clients in this situation. If the spouse was over 62 at the end of 2015, or an easier way to think about it is born before 1/1 of 1954 or 1953 or earlier, so they're grandfathered, the spouse might be able to file a restricted application and get the spousal benefit, regardless of what the spouse's PIA is. So this allows the spouse to receive the spousal benefit, even if their own benefit is higher. What will this do? This will allow the spouse to get 50% while allowing their own, remember we talked about the delayed credits, so that the spouses, by not taking their own, will continue to grow by 8% every year and max out at 70. And then they can switch over to their own benefit, which should be a lot higher because of the credits. And important to know, you have to be full retirement age to file a restricted application. In fact, my neighbor across the street fits this bill, and he just turned full retirement age. She's older, and she already started collecting. So he was able to use this grandfather exception. So again, the magic year is 1953 or earlier, and then there's a potential grandfathering. So how would you maximize spousal benefits? Where the lower earning spouse's PIA is more than 50% of the higher earning spouse, it probably makes sense for both of them to delay until 70. However, if one of them was born in 1953 or earlier and is grandfathered, then that would be the direction to go. And waiting till 70, if they both anticipate an average or longer than average life expectancy, it makes sense to do that. So I have calculators software that I subscribe to, and I'm able to put in this information, and I can play around with the longevity. So if somebody doesn't feel that they're going to live much longer, they're going to be average, then we can figure out what the break even would be. Okay, let's look at an example. Bob and Betty are 59 now. Bob's PIA is 3,000, Betty's is 1,800. Bob's life expectancy is 85, and we calculate 95 for Betty. When should they claim Social Security? So the assumptions here are, we assume a 2% cost of living. They're both 59. Bob's PIA is 3,000, Betty's is 1,800, and there's their life expectancy. So there's 4 possible scenarios. They both can claim early, at the earliest at 62. And this details how that would happen, and it gives you the lifetime benefit. Number 2, they both could claim at their full retirement age, which will be 67 for them. And again, this calculates their lifetime benefit. They can both wait. Betty can claim early at 62, and Bob can wait till 70. He was the higher income earner. Or they could both wait until 70. So what does that look like? There's the scenarios 1, 2, 3, 4. This is the maximum lifetime benefit. The difference between both waiting till 70 and both claiming early at 62 is 700,000 over their lifetime. So it does add up to something. Important thing to consider here also is the surviving spouse. Bob, in the first 2 examples, he doesn't wait till 70. So if Bob passes, then this is the benefit that the wife will step into, Betty. You'll notice scenarios 3 and 4, Bob waited till 70. And in that case, Betty steps into a much higher benefit. And this is a benefit that she collects for the rest of her life. So super important with spouses to recognize who is older, who has the higher benefit, and plan accordingly. Another example, similar, but now Betty's PIA is 800. It was 1,800 before. Everything else is the same. So now when should they take it? We have the same 4 scenarios, and this is the result. So in this case, you'll notice number 3 and number 4 scenarios are pretty close. So in this case, maybe Betty decides to take it early at 62 and forego the difference. And so that's a choice for the couple. Or again, they could wait both until 70. Alrighty, rule number 3. So do you know anyone who's divorced or who may be eligible for benefits? I run across people all the time that they don't realize they're able to get a divorced spouse benefits. I hear, I don't want to bother him with the benefits. The spouse doesn't know. They're not told if you collect benefits off them. So this could be some way you could help your clients. And just to know, an FYI, if you find out after the fact that you were entitled to benefits, they typically only go back 6 months. So they will go retro, but only 6 months. So what are the rules for divorced spouse benefits? So similar to spousal benefits, the marriage had to last at least 10 years or more. The person receiving divorced spouse benefit is currently unmarried. The ex-spouse has to be at least, say, age 62. And interestingly, if the divorce was more than 2 years ago, the ex-spouse does not need to have filed for benefits. So we talked about spousal benefits can only happen when the worker files. But in this case, more than 2 years ago for the divorce, the spouse does not need to have filed for benefits. If you're not sure, I always say it's just a phone call to call Social Security and find out if you're entitled to a benefit. Okay, so notes about the divorced spouse benefit. More than one ex-spouse can receive benefits on the same worker's record. So I'll have an example for you. The benefits that are paid to one ex-spouse do not affect those paid to the worker and the current spouse or other ex-spouses. To apply, you have to show marriage certificates and divorce certificates. Now, important to know, if the spouse gets remarried, the divorced spouse benefits will stop. Not the worker, but the divorced spouse. So important to know what happens if she or he gets married. So here's the example for you. Maybe this crowd knows Johnny Carson. Sometimes I talk about this and I see blank stares. So Johnny Carson was married. He had 4 wives. Jody, number 1, married 14 years. So over 10 years, fine, she could collect benefits. Joanne was spouse number 2. They were married only 9 years, so she was out of luck. Spouse number 3 is Joanna. They were married 13 years, also eligible, and he was still married to number 4, Alexis. They were married 18 years when he passed. So what this is saying is that Jody and Joanna, as ex-spouses, could claim against his record. And Alexis, since she was still married to him, she would get the spousal benefit. And I also had a client who was going through her second divorce. Once that was finalized, she was able to, you can pick which ex-spouse you want to get benefits from. So obviously you would go to the spouse that had the higher benefit. So once the second divorce went through, she claimed her divorce benefits from the first husband who earned the higher amount. Okay, so here's where it can get kind of tricky. So the rule number 4 is for widows and widowers. Again, I've helped people in this area. They don't know that they're entitled. You don't get a letter from Social Security telling you you're eligible for these benefits. And so if you just don't know, you don't know. So let's look at who qualifies for survivor benefits. The couple must have been married at least 9 months at the date of death, except in the case of an accident. Survivor has to be at least 60 years old for a reduced benefit, could be 50 if they're disabled, or to get the full retirement benefit, you have to wait till the full retirement age, again, 66 or 67. The survivor benefit is not available if the widow or widower remarries before age 60 or 50 for a disabled survivor, unless that marriage ends. And then there's a divorced spouse survivor benefit available if the marriage lasts at least 10 years. So back with the Johnny Carson situation, when he passed, the 2 ex-wives, instead of getting a divorced spouse benefit, the spousal benefit, could get the survivor benefit. And what does this matter? So the divorce benefit is 50% of the PIA. Survivor benefit is 100% of the PIA. Okay, so both are receiving benefit and one spouse dies. So here's an example. Julie and Joe are married. Both are over their full retirement age. Julie's benefit is $2,000. Joe's benefit is $1,200. And Julie passes away. Joe notifies Social Security, and his $1,200 benefit is replaced by a $2,000 survivor benefit. And I get this question a lot. They're like, well, what happens to his benefit? Does he get both? You never get both, but you'll get the higher of the two. And technically the $2,000 he's getting is not Julie's benefit. Technically it's his benefit of $1,200. And the $800 is what they call a spousal add-on to get to the $2,000. And again, if Julie had maximized her benefit by waiting till 70, that would have maximized his benefit as well. So how do you maximize survivor benefits? There's two components to it. So the first one is, what age did the deceased spouse originally claim his or her benefit? Did they take it at 62, full retirement age? Did they wait till 70? So that's one component. The second component is the age at which the widow or widower claimed their survivor benefit. So to maximize it, they have to wait till full retirement age. So it's those two components that determine how much the survivor gets. I had one of my own clients that went in there to report that her husband had passed. They were separated, but they were still married. And the woman, the rep, convinced her to apply for her benefits, which she didn't need. And so she did. And she wasn't even her full retirement age. So she wasn't even collecting the max. So I was pretty upset about that. I hear this a lot from people. They talk to 3 different people at Social Security, get 3 different answers. Very common approach. So strategies for widows and widowers. What are the strategies for that? So it's called timing these benefits. So if you're entitled to more than one benefit, how do you know which one to take and when? So if you're eligible for both a retirement benefit and a survivor benefit, you start with the one and then switch to the other. And the rule would be always to take the higher benefit last. So if the survivor benefit is higher, start with your own retirement benefit at 62 and then switch to the survivor benefit at full retirement age. Again, remember, it doesn't make sense to wait past full retirement age. If the retirement benefit is higher, you start with that survivor benefit and then switch to your own retirement benefit. I'm dealing with a woman right now in that exact situation. She's trying to figure out which she should do, which one to apply for, and then when to switch over to the other one. So here's an example of the sequencing that we're talking about. So Wanda is 60, her PIA is 1,200, her deceased husband's PIA was 2,600. Scenario 1, Wanda starts her own retirement benefit in 62 in 2 years. She'll get her $1,200, only 70% of it, right? Because she's taking it early. So she'll get $800. And she can switch the survivor benefit at her full retirement age and get the full 2,600. That was her deceased husband's PIA. Or scenario number 2 would be Wanda starts her survivor benefits right away at age 60, and that's it. So that would be $2,600. And it's also reduced because she took it early, didn't wait till her full retirement age. So she would get $1,859. So which scenario would get her more over her lifetime? It's tempting. And I can see a Social Security rep telling her like, oh, well, you'll get more here. You take your benefits right now, you'll get $1,859 a month. And that appears to be the right answer, but it isn't the right answer. Kind of hard to see here, but it's scenario number 1. So Wanda waits 2 years till she's 62, gets the lower benefit first, allows her own benefit to, and then switches to the higher benefit at her full retirement age. And that gives her the most over her lifetime. So the first scenario, taking it at 60 right away at the higher amount, gets her $1,141,000. And by doing the reverse, she gets $1,423,000. So it's over $300,000 difference over her lifetime, just by knowing which one to take first. Basic rule number 5, there's something called the earnings test. So if you claim your benefits before your full retirement age and you continue to work, they will withhold some of your benefits. And that's called the earnings test. So keep in mind, it's not really a penalty. I hear people call it a penalty all the time. Not really a penalty. If you apply for your Social Security before your full retirement age and you work, $1 in benefits will be withheld for every $2 you earn over. This year, it's almost $19,000. That increases every year. So again, they'll withhold $1 for every 2 over $18,960. However, they don't keep it. They'll adjust your benefits at your full retirement age. So that's why it's not really considered a penalty. However, it does get kind of confusing. If you don't really need the money, just wait until at least your full retirement age or later. It can get kind of messy. I have somebody in that situation. So little known rules about the earnings test. It applies to all benefits received before full retirement age. So sometimes it's not just spousal benefits, but there's survivor benefits, retirement benefits. So anybody that's receiving benefits on the worker's benefit, and that'll also apply to them. it may cause your spouse's benefit to be withheld. So here's an example. So John and Jane are 62. John files and Jane files for her spousal benefit. If John goes back to work, then her spousal benefit will be withheld. And if you're self-employed, you may be subject to extra scrutiny. They may pay themselves a smaller salary to avoid their earnings test. That's the thought. Quick story with a client I'm currently working with now. She claimed her benefits and retired in February. Her husband was already retired. He passed away the next month in March. So she called Social Security. The rep said, you know what, you can go back to January 1st. And she got a nice lump sum check, $4,000 and change. The rep never asked her if she was thinking about going back to work, which she did, or how much she would be earning. She's not full retirement age yet. So she earns about $60,000 a year. So she's going to complete the form to undo her claim for her benefits. And when she talked to them, they said that she would need to pay back that extra that she got paid, either with a check or a credit card. And so something the rep should have mentioned to her, at least asked her if she planned to go back to work. Basic rule number 6, your benefits may be subject to tax. So depending on how much income, other income you have. So let's look at that. So remember 1983 amendment, Social Security became taxable. So this table shows you the taxation of Social Security benefits based on various income levels. Now keep in mind, this is based on provisional income, which is down here at the bottom. Your provisional income is your AGI plus 1/2 of your Social Security benefit, plus any tax exempt interest. So if all of that, if you're married and filing jointly, is under $32,000 a year, then none of your benefit would be subject to tax. Odds are you and most people that you know, and clients, would not be in that situation. So they're probably going to be over $44,000. So up to 85% of their Social Security benefits will be taxed. And then this also outlines other filing status. So what are the ways to maximize your taxes on Social Security? So maybe reducing other income with tax advantage investments, but remember, not municipal bonds. So for example, annuities will provide tax deferral. Anticipate getting your RMDs. Right now it's 72 instead of 70.5. So maybe you should think about, and the academics that I've heard and listened to are advising that in many cases to start drawing down your IRAs before 72, before you have to take your RMDs, especially if you're retiring and you want to wait till 70 to maximize your Social Security, but you need that additional income. So maybe consider taking, withdrawals out of your IRA to bridge that time until 70, and then avoid the tax on the Social Security. Maybe consider converting your traditional IRA to Roth. I get this comment a lot. I talk to people about potentially converting their IRA or parts of their IRA to a Roth, and they mistakenly believe it's subject to your income level, which is not the case to convert, but it is the case to contribute. So you might make too much to contribute to a Roth, but you might be able to convert existing IRA assets to a Roth. Consider delaying Social Security, so that'll reduce the number of years that your benefits are subject to tax. This next one really isn't, reducing your expenses. No matter how much you reduce your expenses, you won't be under, that amount of money. So you won't be able to avoid paying taxes on it. And then, as I had mentioned in the beginning, just continue to manage your taxes throughout retirement. It's an annual thing. So, these are the kinds of questions that I get all the time. When should I apply? What if I want to keep working? What if I've already applied? How much would my benefit be? How do I coordinate with my spouse? What's the best long-term strategy for me? And oftentimes I will tell someone what the maximum is, how to maximize it, but it's up to them. They might want to pick some sort of a hybrid approach, not the earliest, not waiting till 70, but something in between. I get I get texts, I get phone calls from people. They give me like 2 sentences. I have a quick question for you. I'm sure you get this too. My CPA says she gets that question all the time. The problem is the answer isn't very quick. It's very individual. I need to know, I have a whole one side of a page input sheet. Were they married before? How many times were they married? How long was their marriage, right? They may be able to get divorce spouse benefits. Did a prior spouse pass? Are they able to get survivor benefits, right? There's a lot of information to gather. And as I mentioned, review your statements online, make sure that they're recording your earnings correctly. And like, most importantly, don't listen to your friends, don't listen to other people, that had some sort of experience, because it could be completely different from your situation. So that's the basis of my presentation. And was it Terry, you were going to maybe help me look through there might be any questions in the chat?
Yes, we've got one in the chat from Cassandra. If you are a surviving spouse and your spouse passed away at 62 before claiming, can you claim your spouse's benefit upon reaching full retirement, or is it better to wait until 70?
Yeah, so one of the things to know, and that question is one of the things that got me to really understand how complicated Social Security is. It was something similar where a couple, he was approaching 62 and they were trying to decide if he should take benefits. He heard a diagnosis that he, only had a few months to live. And so he thought the best thing to do would be apply right away at 62. At least he would get a couple of months of benefits. And that was actually the wrong answer, because had he not applied, her widow's benefits would have been based on his benefit at his full retirement age. But the fact that he went and got the benefit early at 62, she would be able to get, a benefit, but a lesser benefit because he started getting it early. So it's a similar question, Cassandra. If you're a surviving spouse, passed away before claiming, can you claim your spouse's benefit upon reaching full retirement age? So yes, if you could collect it sooner, but in order to get the max, you would have to wait till full retirement age. But for you to wait till 70, there is no maxing at 70 with the spousal benefit. So it would be, you would get the most at your full retirement age.
And then we have it.
Oh, I see. What about public employee pension offset? Yeah, there's a whole set of rules around that for people, like teachers don't put into Social Security. So I do have clients who both worked and put into Social Security before they became teachers. And then once, for those of you who may not know, teachers don't put into Social Security, at least in the state of California. That's not the case everywhere. So they may be entitled to, depending on how many years they put into Social Security, they may be entitled to getting something, but they do offset it because they had worked. They didn't put into Social Security. So I do have a calculator for that. And unfortunately, my clients who are in that situation, they get their earning statements from Social Security, and it mentions that this might apply to you, but they don't actually give you those numbers on your statements. So you have to call. So I have them call Social Security and find out what his exact numbers are. They won't tell you that, but I do have a calculator. I can put those numbers in there and come up with that.
How does Social Security disability figure into this? That's from Aita, or does it? Yeah,
Aita, that's a whole, I don't even go into the SSDI part of it. So I don't believe it figures into it at all. I do refer out to other people that are knowledgeable about the SSDI program, but I don't believe it figures into it.
And I can ask, we have a little more time in the program, so I usually, unless somebody else threw one in. No, I can, while we're waiting for other questions, I can always think of questions. It's very interesting what you were discussing about, with the lower income spouse earning, collecting early. And I didn't quite understand, for many couples, we've got one higher income spouse, and that spouse is waiting to maximize until, the maximum, the age where you can get the most money. and you have a lower income spouse, but who's maybe a little bit younger. But is there, did I understand, is there a downside for that? It is for that lower income spouse to start collecting early? Like, is the collection early by that lower income spouse who maybe has very little Social Security benefits, but the higher income spouse has much more? Generally, strategically, that lower income spouse, by collecting half of the higher income spouse's benefits, that person, let's say, went to full retirement age, that's a benefit to them, and there's not a downside. I didn't really understand completely, so if you can clarify.
I guess when you say minimal, I guess I would have to say, is it less than half? Because we had two examples. We had
less, usually.
Yeah, less than half. Yeah, so I think in that example, it showed that it benefited to wait and not take it early. So you have to just look at it over the lifetime, benefits.
But any spouse who is or couple where one spouse's benefits will be less than half of the other spouse's benefit, it behooves that spouse or the family, the couple, to look at collecting Social Security earlier at some time, at least to examine the issue.
At least to examine the issue, yes.
Okay. And I'm looking to see if there are any other further questions out there.
There are, Melanie.
Let's see. Okay, we have, right, Melanie. Oh, and another from Aita. So Melanie.
Gosh, some financial advisors say that you can earn more money with conservative investments. I mean, it's 8% guaranteed. So for every month past your full retirement age, you're going to get 8% more in your Social Security benefits. So especially if you're talking conservative, what can you expect for conservative investments right now? 4%? 3%? And this is guaranteed. Well,
Yeah.
Social Security stays around. Yeah, I don't see that. I mean, I like I said, I follow the academics and what they're writing, and it's a trend now. And thank goodness I am reading that more people, about half, used to take their Social Security at 62, the earliest. And that's changing. So the word is getting out there, and we're encouraging people to wait, and it's working so very slowly. So I don't agree with that, actually. Maybe the advisors are trying to get the assets under management and want that. I don't know. So next question, what if the married spouse is now divorced or married outside the U.S. as an immigrant now living in the U.S. and paying towards the system? How are their benefits determined based on foreign marriage? Oof, that's a whole nother area. I mean, I'd have to have more detail, but some other countries we have the treaties with. And so I know that with this Canada, so I knew someone who was getting a Social Security benefit from Canada and also put into the system here. And that person mistakenly thought they were going to get both. And actually that similar offset that we talked about earlier would apply. And so we would take into consideration what they were getting for a benefit from Canada and lessen what they would get here. So it is a whole nother set of facts. It's just a whole different fact pattern if you're now talking outside the US. So by the way, I don't always have all the answers, but I have a person that works for the Social Security Administration. Her job is strictly to work with financial advisors, CPAs, to help them answer questions for their clients. So I go to her and I go to the company that produces the software that I use. There's an expert there too. So I could typically go to both of them, and within 24 or 48 hours, I get a response. And these types of questions, when we're talking outside the country, usually a person from the SSA will send me some links that'll kind of at least put them in the right direction.
There's also a question in chat, I believe.
Oh, okay. Let's see.
82 still working after.
Oh, there we go. Okay. Thanks, Alex.
Should I retire fully? Will I be eligible for an increase in my monthly Social Security since I've contributed for many more years? 82. Okay. If you continue to work and put into the system, they will continue to recalculate your highest 35 years. So assuming you're, I don't know how 100,000 now compared to before. And earlier they do apply, a factor, an inflation factor. So, when they compare it at 62, they're comparing apples and apples, but I don't know what the earnings was before, but on a broad level, if you continue to work and you're putting more into the system, they will recalculate. Now, you won't get less. They'll always use the highest 35 years when it comes time for you to get your benefits. So hopefully that answered your question.
And we have, let's see, we have some others there. We have Melanie and Wendy. Melanie, what is the maximum amount of Social Security benefits you can get now? Is there a
So that was early on. So the maximum amount for those who are turning 62 this year, so when they're calculating, so if you had put the most in every year for 35 years, you would be getting $3,262 a month, $3,262. And there is a max because, as you know, with payroll taxes, there's no limit to the Medicare, but they do limit you on the Social Security. So that's where this 3262 comes in, assuming you hit the ceiling every year. Can you collect Social Security if you reside at? Yes, absolutely. So you just tell them where you want the check sent, and your check will go wherever you reside. In most cases, I think there's a few countries they won't send the money to, but probably where you're thinking of going, they would send the check. So yes. All right. So Michael, how long do you have to be married for the spouse to claim your benefit? 9 months. My partner's 56, I'm 66. Yeah, it's just 9 months is it. That's all you have to be married, unless there was an accident, and then it would be less. Once someone goes on disability, SSA. So you're automatic, when you take Social Security disability at 63, they'll automatically switch you over to Social Security at 65. So your disability at 63 was determined to be your full retirement age benefit. So it typically won't increase. The only way I can think it would increase if there was just a cost of living adjustment to it. Eliza, that was your question. So it won't bump up that much other than maybe the cost of living. How does SSDI, again, I don't, that's a whole nother program. Is divorced spouse survivor benefit linked to age divorced spouse starting to take his benefit? Divorced spouse survivor benefit linked to divorced spouse taking his benefit. Yes, that is always a factor. That's one of the two factors. So how old was the divorced spouse when he first started taking his benefit? Definitely does affect the divorced spouse survivor. Yes, the answer is yes. So that's one component. The second component is when the divorced spouse survivor takes her benefit.
See, the next question is one probably on everybody's mind, because you could appreciate, anybody listening appreciates the valuable service this is. And so what will probably be our last question here before the end of the program is, what do your services cost? And this person says to analyze a couple's retirement income situation vis-a-vis Social Security and pension. That's a general question. Like, people want to use you. You could see the value. Sure. What does it cost?
Yeah. So I have a complimentary, discussion with them to find out how complicated their situation is, even though everybody thinks there's a simple, if it is truly a pretty straightforward situation, they weren't married before, there was no surviving benefits, then it would be, I do it $300 an hour, 2 hour minimum. So in very, very simple situations, $600 should cover doing that. So I have the fact finder. I would need completed, and I need a pretty current Social Security statement, and I put that in the calculator, and then we sit down, and the output is exactly what we were looking at, where they had, what the input was, and then the earliest, the maximum, and then we could, and I've done that. I could do that on the fly, especially with the Zoom meetings. We can say, well, what if she took it at 63 and I did this, or what if she took it at 60? So we can make those adjustments and kind of see, where they want to go if they want some hybrid. So yeah, to our $600 would be the minimum, and then it would just go up from there if there's more involvement as far as other marriages and things like that.
I think we can squeeze maybe one more in, Joanne. Cheryl asks at the very end, I don't know if the Social Security amounts you have figured in your examples not include tax owed against it. So if you say the maximum is 3262, if taxes are not calculated, then this is not for the amount. Yep. So right,
because we wouldn't know what your tax bracket was, so everything is in gross terms.
Okay, great. Joanne, this is incredible. I mean, not many people. I mean, I don't know of anyone else really that has the expertise that you do in this area. So thank you so much for sharing. And maybe when there's some changes in Social Security a year plus from now, we could have you back.
Well, that would be great. Again, thank you so much. I enjoyed being with the crowd. Good questions at the end too. And I'm willing to stay. I don't know who is in charge of the Zoom thing. If there's any questions, I can hang around.
We usually pop off the Zoom, but I'm sure anybody could email you too with your contact information. Thank you once again, Joanne. Thank you everybody in the audience. Fantastic program.